You're lying in bed, lights off, phone glowing. You open your banking app, and there it is, a number that finally looks real, not life-changing yet, but bigger than it used to be. Maybe it's $5,000, maybe $10,000, maybe the first time your savings has a comma in it, and suddenly your brain starts racing. You're doing it. You're saving. You're making progress. You're finally becoming the kind of person who invests. So naturally, you do what the internet tells you to do. You open YouTube. Best investments right now. Immediately the circus begins. Crypto thumbnails screaming, 100x coin before 2026. Stock gurus pointing at charts with arrows going straight up. Real estate influencers standing in front of houses that definitely belong to the bank. Everyone seems confident. Everyone seems early. And suddenly your calm little savings account feels slow. Too slow. So you jump in. A little crypto. A few stocks I'm mentioned. Maybe a trendy ETF because a comment section said it's safe. And for a while, it feels smart. You check your portfolio more often. You imagine your money multiplying. You feel like you've entered the real game. Then life happens. Your car needs repairs. A medical bill shows up. Rent increases. And suddenly the money you invested becomes the money you need. So you sell. Sometimes for a small gain. Sometimes for a loss. And the system doesn't care. Because here's the catch. Most people don't fail at investing because they choose the wrong investments. They fail because they follow the wrong order. They try to build the roof before building the foundation. They start investing before their money system is stable. And when real life hits, the whole structure collapses. Not because you're bad with money, because no one told you the correct order. And the system, it actually benefits when you don't know it. Today we're talking about the investment order that actually works. The boring sequence wealthy people quietly follow. Ignore it, and investing becomes stressful. Follow it, and money starts behaving very differently. Here's the uncomfortable truth. Humans love the exciting part of money, the investing part, the charts, the growth, the idea that your money could double. But investing is actually the fourth or fifth step in the process. Most people start there, which is like installing solar panels on a house that doesn't have walls yet. It looks impressive, but it collapses the moment a storm arrives. According to Federal Reserve surveys, a large percentage of adults can't cover a $400 emergency expense without borrowing or selling something. That means millions of people are investing without financial stability underneath. And when emergencies happen, they liquidate investments early, which destroys the very thing investing needs most. Time. Time is the real engine of wealth. Not stock picks. Not crypto. Not luck. Compound interest only works if the money stays invested. But if your investments double as your emergency fund, they're not investments. They're temporary savings accounts with stress attached. And this isn't because people are irresponsible. It's because the system markets investing as the first step. Apps make it look easy. Open an account. Buy a stock. Watch your money grow. No one stops the onboarding process to ask, hey, do you have an emergency fund first? Because stability doesn't generate excitement. Trading does. And the financial industry makes far more money from activity than patience. You're not broken if this feels confusing. That's almost everyone right now. The rules of money aren't hidden, but they're rarely explained in the correct order. My name is Peter. I'm not a financial guru. I'm not here to tell you to stop buying coffee or cancel every streaming service. And I'm definitely not here to pretend money is simple. I'm just obsessed with how money actually works, especially the parts that feel slow, boring, or unfair. Quick disclaimer. This is education and entertainment only. I'm not a financial advisor. I don't know your specific situation. Before making financial decisions, talk to a qualified professional who understands your circumstances. All right, let's talk about the investment order that actually works, not the flashy version, the functional version. Think of money like building a house. Everyone online wants to show you the roof, the investment portfolio. But a house only works if the layers underneath exist first. Phase 1 is the foundation phase. This is where most people quietly rush because it's boring. But skipping it guarantees problems later. Step 1 is stability. Before investing a single dollar, your first goal is survival protection. That means a basic emergency fund. 3 to 6 months of expenses. Not invested. Not in crypto. Just safe and accessible. Why? Because life is unpredictable. Cars break. Jobs change. Health surprises you. And if those events force you to sell investments early, you reset your wealth clock. The second step is high-interest debt elimination. Credit cards charging 18 to 25%. That's reverse compounding. Imagine investing and earning 7% while paying 20% interest. You're running uphill in a sandstorm. Eliminating high-interest debt often produces a better return than any investment. But again, it's not exciting. There's no chart, just fewer bills. Step 3 is income stability and cash flow. This means your monthly life actually works. You're not constantly scrambling. Your expenses fit inside your income. This is where many people feel their first real financial breathing room. Only after these layers exist do we enter phase 2, the part everyone online starts with, investing. But now the rules change, because your investments are no longer emergency money. They're long-term capital, which means they can finally do what investing is supposed to do: sit quietly and grow. Let's talk about the math for a second, because this is where the order matters most. Imagine 2 people. Both invest $500 per month. Both earn roughly 7% annually. But one of them has no emergency fund. Every couple years, something breaks. Car repair, medical bill, job interruption. They withdraw money early. Each withdrawal resets part of their compound growth. After 20 years, their portfolio might be tens of thousands smaller. Not because the market failed, because the structure underneath was unstable. Now, compare that to someone who built the foundation first. Their investments stay invested. No interruptions. No panic selling. That difference is powerful. Vanguard research consistently shows investor behavior costs people about 1 to 2% per year in lost returns. That might not sound huge, but over decades, it can cut total wealth dramatically. And most of that loss comes from timing mistakes, buying during hype, selling during fear, or withdrawing early because life forced their hand. Boring stability prevents those mistakes, and boring wins, almost every time. Let me tell you about Alex and Jordan. Alex loves investing, always has. Alex watches the markets, reads newsletters, tries new opportunities, and every time extra money appears, Alex invests it. Stocks, crypto, startups. It feels productive, but Alex skipped the boring layers. No emergency fund, credit card balance floating around. So when real life happens, investments get sold. Again and again. Alex is technically investing for years, but progress is slow because every crisis resets momentum. Now Jordan. Jordan follows a different approach. Jordan builds the base first. Emergency fund, debt cleared, monthly expenses under control. Only then does Jordan start investing. And because the foundation exists, those investments stay untouched. Years pass. Compound growth does its quiet work. Jordan doesn't talk about it much. It's not flashy, but the numbers grow steadily. Fidelity reports show households with emergency funds and automated investing are significantly more resilient during financial shocks. Same income, different structure. Alex looks more active. Jordan becomes wealthier because Jordan followed the correct order. So what does the investment order actually look like? Simple. Not glamorous, but extremely effective. Step 1. Build a basic emergency fund. 3 to 6 months of expenses. This is protection, not growth. Step 2. Eliminate high-interest debt. Anything charging double-digit interest. Credit cards especially. That's negative investing. Step 3. Stabilize your monthly cash flow. Income covers expenses. Breathing room exists. Step 4. Start consistent long-term investing. Index funds, retirement accounts, Diversified portfolios. Nothing flashy, just consistent. Step 5. Increase contributions as income grows. Raises become fuel, not lifestyle inflation. Step 6. Protect your investments from yourself. Automation helps. So does ignoring market noise. Step 7. Let time do its job. Compounding needs patience, not adrenaline. Wealth isn't built by finding the perfect investment. It's built by creating the right structure before investing. The real catch is this. Most people want the exciting step first. They want investing to feel like progress. But investing only works when the boring layers exist underneath. Protection, stability, discipline. If you skip the order, money feels stressful. If you follow the order, money becomes predictable. And that's when investing finally starts working the way it's supposed to. So protect your first financial foundation, like it's the floor, not the finish line. Because the real secret to investing isn't finding the next big opportunity. It's building a system where your money can finally sit still long enough to grow